Okay. Example 2.3, was it that you were doing? All right, so I don't know why I'm always picking up the red one. Example 2.3. B is a subsidiary of A. A, B. During 2008 and 2009, A sold inventory to B. At a profit of 25% on cost. Cost 100, profit 25, selling price 125. Agree? During December 08, B had inventory on hand of 300. So beginning of year, I had 300 on hand. End of year, I've got 200 on hand. Profit, I divide by 1.25. Yeah? So it works out to, is it 60 and 40? Is that right? 60 and 40. Be careful if they say that profit is based on selling price, then it's a straight 25, right? If it's based on cost, it's 25 over 125. And then I do tax. So tax at 28% is 16.8 and 11.2. So I always just do the tax immediately. All right, so the first thing is the normal journals from second year. Beginning of year journal, debit, retained earnings. I don't know why it's gone so awry now. Let me just calibrate it. I don't know why I'm writing there and it's showing somewhere completely different. It's been working fine all morning. All right, so beginning of year, debit, retained earnings, credit, cost of sales, credit, not credit, debit, tax expense. Yeah? There's nothing left in my P&L, in my balance sheet, in my financial position. All I'm doing is moving profit into the current year. This inventory was on hand from the group perspective at beginning of year. It must move the profit to current year. It's sitting in the books of the parent at beginning of year. So that's your entry. Then this is the new one, the tax expense, which is new. And this retained earnings will be net of tax. Yeah. Then end of year. The entry is to reduce inventory, so debit cost of sales, credit inventory by the 60. The tax is the opposite. I've credited financial position. I'm going to debit financial position with the tax, SFP, and then I've debited P&L. I'm going to credit tax expense in the P&L with the tax. 11.2. No, 11.2, and this was 40, not 60, 40. Okay, now, the only other thing to consider, and you can see the tax entries are easy, right? The only other thing to consider is this direction over here. When I look at this direction, they have the inventory, they have the profit. Do you agree? When I'm sharing profit, there's an NCI that's sitting over here somewhere. When I'm sharing profit, if I adjusted B's profit, I would have to adjust NCI, isn't it? But in this case, it's A's profit. So when I make the adjustments to cost of sales and to retained earnings, I'm making the adjustment only to A. I'm not making the adjustment to NCI. If it was the other way around, then they would have the profit and they would have the inventory. So when I was working out NCI's share of profit, I would need to go back and fix their NCI for the balances. Agreed? Agreed. Okay. And I would have to fix NCI at beginning and at end of year. Okay. So that's inventory, the same as what we learned in second year. And I think if you look at some examples, I think they have some further examples, but the further examples is just like the other way around then. B sold inventory to A. Yeah, it's just all the same thing. Okay, we're going to look at property, plant, and equipment. So we're looking at example 2.6. So that's the first intercompany transaction, inventory, sale of inventory. So the next one we're going to look at is example 2.6, which is PPE. Now remember, with PPE, what we're doing is we are reversing the profit and bringing the cost of the asset back down to what it needs to be, and then we're making depreciation adjustments. Yes? So the machine was sold from B to A in this case. So when we're looking at the analysis, or when we not at the analysis, when we're analyzing this has profit and this has the asset. So therefore, if we're adjusting profit, which is what we're going to do, we must remember to adjust NCI in the right periods. Yeah? Because when you look at statements of changes in equity, we start with NCI at beginning, movement, end. So NCI at beginning will include these opening adjustments, isn't it? All right, so in this case, the first journal entry is to remove that profit, but it's in the past, so it goes to retained earnings, isn't it? So the first journal entry, which you'll see there, is a debit to retained earnings in 07. I'm going to just look at 07. Is a debit to retained earnings and a credit to PPE, and then the 1400 to tax. Retained earnings is always net of tax, so it's one net entry when we make entries to retained earnings. Then we have two entries to do. We have one to do for the beginning of year, and then one to do for the current year, and the adjustment is 1,000 and 280 for tax, isn't it? You'll see it in the 2008 year probably, or 9 year is the best to see it, in the 8 year. You'll see they put it all in one journal, but I like to see it in two journals, yeah? So I like to see this journal first, then the since to beginning journal, and then the depreciation journal for the year. And then you'll see that that journal and this journal both go to retained earnings, and that journal goes to depreciation. It goes to the P&L. Yeah, and then the tax always goes the opposite way. So I debit accumulated depreciation and credit depreciation. I'm reducing depreciation because it's in the books for 20,000, but I'm going to make it back to 15, so I must reduce depreciation. That reduction of depreciation then results in the deferred tax going, or the tax expense going up. Yeah, so I land up with a debit to tax expense, making my tax expense bigger, and the credit to deferred tax. You'll see that when I made this adjustment to 1,400, it was a debit to deferred tax, and that over the 5 years, I'm going to do credits to deferred tax, and it's going to disappear. Yeah. All right, so that's the PPE. And as I said again, because I am looking at an upstream transaction, the NCI would get affected. But you don't see the journals for the NCI. At honors level, they do show the NCI piece of that journal when they ask you for the journals. Okay, so then there's just one more that I wanted to look at quickly before we go and look at the assignment question. Last year we haven't done one. We're going to hopefully finish one because it's a consolidation. There's one more that I want to look at, and that's impairment of goodwill. Did we have impairment of goodwill at all in second year? I'm sure we did, isn't it? Impairment of goodwill, you don't remember? But every year, goodwill needs to be tested for impairment, and it might be impaired. A normal impairment of goodwill entry would be to debit other expenses and credit goodwill. And goodwill normally has no tax implications. Do you agree? No tax implications for goodwill. Unless they tell you that you're getting a tax deduction on the goodwill, usually there's no tax deductions on the goodwill. The only thing to remember then with the impairment of goodwill is, of course, if it happened in prior years, the entry goes to retained earnings. It doesn't go to other expenses. And then, this is important, if NCI is at fair value, then when I impair goodwill, I give them their share as well. So I would do that, and if NCI is at fair value, then you adjust the profit attributable to NCI when you do that calculation. So when you do the calculation of profit attributable to NCI, then you put the goodwill impairment in that calc. If NCI is measured at proportionate net asset value, at percentage NAV, then they've got nothing to do with goodwill, isn't it? So you must just be careful that when you do the calculations, all the goodwill write-off must go to the parent and none of it to the NCI. So that's the only thing to remember. There is one thing which I always used to think didn't make a lot of sense to me. You know how when we looked last week, the NCI goodwill is not proportionate. It's not like if the percentage is 80-20, it doesn't work out 80-20. And it won't, because we bought control. That's why we paid that much more. NCI doesn't have control. That's why theirs is less, isn't it? Okay. But if but when we give them their share of the goodwill impairment, we do a straight 80-20 or whatever the percentage is. We don't worry about apportioning it to what their share actually was. Yeah. So it's a little bit funny that I think it would make more sense to do it proportionately, and I remember at one stage doing it proportionately, but now we don't do it proportionately, we just do a straight, whatever the percentages are, that's what we do. So if you look in your notes, you'll see page 63. In fact, look at page 66. There's an example there, or page 6. Yeah, there's examples all through there of adjustments to goodwill with the journal entries. But on page 66, you'll see the journal entry: debit impairment loss in the P&L, credit goodwill, and then adjusting the NCI's share of profit by that amount. And you'll see that we're giving them a share of loss because we're debiting the SFP and crediting the P&L. And just one more thing to bear in mind, when we impair goodwill, but I'm sure that you've seen at second year level, they either can say to you it's been impaired by a certain amount or to a certain amount. So you just need to be careful of what that wording is. If they say it's impaired by 2,000, then whatever it was, we subtract 2,000, that's our impairment. If they say it's impaired to 2,000, whatever it was to get you to 2,000, that's the impairment. Okay. So that's basic consolidation. Do you agree? Nothing new. I don't remember. I think at second year level we maybe didn't focus on the since acquisition impact of elimination entry of acquisition entries, and we also didn't look at tax, and now we do. Okay, so the assignment. Assignment 1. Sorry, I'll just switch off. Here we go. Assignment 1, last week we did a couple of those multiple choice questions, but now this week we'll be able to do the rest. So last week we had done paragraphs 1, 2, and 3, if you recall, if you look at the information. Paragraph 1 was about the acquisition, and then paragraph 2 was about fair value adjustments, and paragraph 3 was about preference shareholders who own preference shares. And then it says, since the 1st of June, FIG sold inventory to Olive, and on the 1st of March, Olive sold furniture to FIG. And then they also say, the group measures its equity investments at fair value through OCI. Yeah. So there's a couple of things then if I go back to our big picture of a consolidation, there's a couple of things. Last week we did this adjustment, yeah, and when we did that adjustment, we adjusted land. There's no subsequent impact on land. Do you agree? We don't appreciate land, and unless they said to you that the land has subsequently been sold, which I don't think they did, there's no since, you know where we do this thing, since acquisition implications, there's nothing for land. The only thing would be if it was sold. But we also did make an adjustment to inventory. Yeah, we wrote down inventory. So that adjustment to inventory will flip because it's now been sold, yeah, in the next year. So acquisition was 1 June 13. So it was in the 2013 year-end period. We are now at December 15. So remember from second year, I used to always draw these timelines for you, isn't it? Acquisition. December 13, December 14, December 15. Here's December 15, which is end of year. Here is acquisition. 1 June 13 acquisition. So we had a December 13 year end, and we have a December 14 year end and a December 15 year end. December 14 is beginning of year, December 15 is end of year. So we're going to be looking at a movement from there to there for beginning and there to there for current. Yeah. So the transaction happened there. Whatever inventory we made adjustments to there was probably sold here, isn't it? So it needs to flip. Okay, so that's the first thing. Then there are some intercompany adjustments. Let me just see if there's dividends. There are dividends paid, so those need to be adjusted. And then there are some intercompany adjustments. There's inventory and there's furniture. Inventory has been sold since then, they say. Since the 1st of June, there was inventory sold. So there is going to be some inventory beginning of year here, and there's going to be some inventory end of year over here. Yeah. And then on the furniture was sold here. Furniture sold. So it's all current year, and then there's going to be a bit of depreciation. Do you agree? But just for a piece of the year. Okay. So they ask you, so that's all you have to go do is the calcs for that inventory, the calcs for the furniture, and we have to do the fair value adjustments on the investment. If you look, it says investment in olive at fair value. So over here it's been carried at fair value of 820. If you look at what was paid, we paid 710. We paid cash of 600 and a piece of equipment for 110. So there's been a 110 movement. Yeah. If we look at the mark-to-market reserve, you'll see the mark-to-market reserve is only 61. Am I reading it right? 820. 710. Doesn't seem to add up. Oh, it was in the current year. The difference must be in the current year. If you look at the numbers, you'll see that it says mark to market 61014. It says deferred tax on mark to market 20513, and it says OCI net of tax 28473. I'm sure if you add that up, it will add up to the 110. A straight 100? Not 110? Maybe there's some more tax somewhere. 110? Okay, excellent. Because that's what we expect to see, isn't it? So there's the numbers that you have to reverse, isn't it, out of the mark-to-market and out of the deferred tax. All right. So let's look at what they ask in the required, so we know more or less. Required 1 we had done. Required 2 asks you what amount will be disclosed as revenue. We didn't do the revenue entry, but you know there's that entry when we sell to debit revenue and credit cost of sales, just to reverse the revenue. Yeah? The revenue for the year. Then number 3 and 4 we had done. Number 5 asks you what will be the total dividends paid to NCI. Remember there's an ordinary NCI and there's a pref NCI. Number 6, what will be disclosed as PPE? It will be parent plus sub plus the on-ac adjustment to land, and then there's this adjustment here to reduce the furniture and to reduce the depreciation. Yeah. What will be disclosed as cash and cash equivalents? I think that's just a trick, because if you look at the face of it, yeah, it just looks like it's just 2 numbers. There's no overdraft or anything like that, so that's fairly straightforward. The amount that will be disclosed as the mark-to-market. I think it's going to be 0, hey, because we're going to reverse that. Doesn't look like there's any other mark-to-market. What will be disclosed as trade and other payables, because there's a money owing for the inventory. Okay. Sounds doable? Sounds doable. Okay, no tax entries or anything like that. Almost sounds like it could be a little bit of second year. The only thing that I see there that may be a little bit of third year is the since acquisition impact of that inventory. All right. Let's see if we can do that. We've got, what, about 15 minutes? 15 minutes. Let's see how far we can get. What doesn't get done, if you could just do it, finish at home. But let's see. I'm going to try and see if I can finish it in the time. Remember that the principle is parent plus sub plus or minus adjustments always, yeah? Parent plus sub plus or minus adjustments. Okay, so go finish it at home. Those of you that are still far from finished. And then we'll look next week or before it's due. Next week we're going to do vertical groups, which you haven't never done before. So today was a lot of revision, isn't it? It was basically all of second year, boom, in one lecture. But next week we're going to talk about vertical groups, which is brand new. You've never done it. And there are some tricky bits. So that's what we'll do then. And there's nothing on assignments to do next week, so then we'll be able to come back to this one and make sure it's done.